Jesse Livermore. I've talked about him over the years. He's a very controversial investor. However, very successful. He made $100 million in 1929. Now, he went short the market. So Livermore, his skill set was primarily, good stock selection, knowing, getting his timing down on his buys. But most importantly, he knew when to sell. First, do not be invested in the market all the time. There are many times when I have been completely in cash, especially when I was unsure of the direction of the market and waiting for a confirmation of the next move. Second, it is the change in the major trend that hurts most speculators or investors. I think we're seeing a trend change here, and also if you think about the uncertainty out there right now, we're in a war. Interest rates are climbing. We'll talk a little bit about that. We've got inflation flaring up. We got a pretty bad inflation report this morning. So we're seeing a change of character in the market. George Patton said, lead me, follow me, or get out the hell out the way. What I'm trying to say there is that when the generals lead, the troops will follow. So we know that we've had a major breakdown in the technology stocks, which have been leading. They're the generals. Now the question now becomes, is this going to affect the whole ball game? I think it will, and it probably will. Now, this all started last week when Broadcom announced earnings, and they missed revenues for the first time in a long time. And you can see the breakdown in the stock price. I'm mentioning here that Trump wants to go to semi-annual earnings reports instead of quarterly reports. I think it's a great idea. I wish we would do that. The volatility every 90 days is pretty brutal. If we could spread out the quarters, maybe a company has a bad quarter, then has a good quarter, and it kind of evens things out. But my point is, this current situation that we're in, there was really two earnings reports last week that got my attention. One was Palo Alto Networks and Broadcom. And so if you think about it, back in 2000, in the first quarter of 2000, which was the dot-com bust, Cisco missed its revenues for the first time in an extended period of time. Capital gains, you have to deal with capital gains when you sell. It's just a fact of life. If you study the capital gains tax, you're going to find out that it's probably one of the worst taxes out there. You might want to pause your video player and look at this, but it basically is poo-pooing the capital gains tax, which I think is a ridiculous tax. It's double taxation. In other words, you have to make the money to invest, and then you have to pay taxes again. I don't like that tax. Now let's talk about stop loss orders. Now we use something called a trailing stop. And when you look at a graph and you have a system or a strategy, you must honor your stops, because what can happen is that if you get down in a stock 10, 20, 30%, well, if you're down 30%, you got to invest in something to make 60% in order to make it up. So I usually will stop 6, 7, 8% loss. I can easily handle. Also, position sizing is important. Usually I'll start out with about 5% of my portfolio in something with a trailing stop. So let's think about it. If I've got 5% of my portfolio and I have a trailing stop of, let's say, 6%. So that means I've impacted the portfolio 6% times 5%, or 0.3%. You can easily recover from a 0.3% loss. So stop losses are important. You can always buy the position back. Now what we're seeing here in this market is a change of character. Change of characters typically come after a parabolic up move, which we've been getting especially in the semiconductors and the AI related stocks. However, it's been a pretty severe drop off. However, we don't want to get too negative, because we are still in what IBD calls a power trend. And so with a power trend, you have these rules to have a power trend. which we've been in. Since this low here, we have entered a power trend. Now, the power trend ends when the 21-day moving average crosses below the 50-day. So we're still in a power trend. So we don't want to get too negative here. Now, the S&P, let's see here. That didn't fit on the page right. The S&P, I'm looking at this graph on the S&P because you can see here that on the NASDAQ here, we have broken down below the 21-day. Volume has been coming in pretty heavy on the sell side. We've broken the 21-day, but we're holding that 50-day. Now, if we break below that 50-day, it's just not good. So we're making, what's happening here is we've got a top, we've got a double top, we've got a low, not making a new high, a lower low, not making a new high, but not making a new low. That's going to be important. So with the S&P, we're seeing basically the same pattern. You know, we've got the top, we got the double top. Now, when you have an ascending top, that's not as bad as a descending top, but it's still a double top. So you've got, you know, the breakdown below the 21-day, and you've got the lower low, not making new highs. You really need to be watching this market right now. I think I'd be inclined to sit on the sidelines, which I'm doing. This is our aggression index, where we're measuring the NASDAQ compared to the consumer staples stocks. This is an early warning system. You know, back at the beginning of the year, we got the early warning where the aggression index broke down, and we're now seeing a breakdown here. Now, the sell signal comes, which we're not on yet, but we're below both moving averages, and when the lower moving average turns down, that like here, that's where you get your sell signal. And it can either be the 25-day or the 50-day moving average. But the point is that when the institutions who drive this market, they control 90 to 95% of the volume. When the institutions get in trouble, or they're worried about trouble, they can't go to cash because they're so big. And there's rules to prevent them from doing that. So what they do is they start shifting the portfolio around into defensive areas such as consumer staples, utilities, things that are defensive. So this is nothing more than just an early warning. Again, I would recommend sitting tight here. Unemployment rate came out on, for the June unemployment right where it's supposed to be at 4.3%. So, job growth is steady. It's some government jobs are being lost, but it's being picked up in the private sector. Primary trend for the S&P is up still. So is the NASDAQ. So we don't want to get too negative here. But if we start breaking down below the 200-day, that would be troubling. Interest rates are kind of creating part of the problem here. Over the last 125 trading days, interest rates are up 8.5%. Now that's the 5-year Treasury, but as you can see, actually, it's somewhat improving. You're not breaking above the 4.65 yield, but interest rates are a problem right now. New lows are a problem. We're getting way too many new lows on the New York Stock Exchange for too many days. This is a way to indicate that the sellers are pretty much in control. Now, last but not least, sentiment. The last survey was somewhat where people are becoming a little optimistic, but not enough to get positive. So we're still of the opinion that sentiment is positive and that we're not seeing a bubble as far as I can tell based on sentiment. So if you have any questions, please let me know. Thank you very much.